Good morning, ladies and gentlemen. Well, let us start the review of the week with the most important contract. The 5-year note, as we keep on telling you, is now going to be the leader in the interest rate sector in the United States. And as we keep on saying, if you focus on interest rates and get those right, everything else will follow. Well, as you can see, we broke the all-important 1.875% level on a closing basis. We traded nearly the whole week above it, but we closed very strongly above it, and now we are destined to trade 216 to 235. 235 is going to be an incredibly important level. It catches all these lows back in 2008 and then in early 2011. That is going to be a very important swing level from which we could have quite a bit of consolidation going into the first quarter of next year, and then we decide whether we bust that upwards or not. If we do bust that upwards, we are destined to go and trade nearly 3%, which would be a very large move in terms of, you can tell that it's going to be 20 to 30% higher rates than they are now, and that is going to have some very profound impacts on the other asset classes. If we drill down to a daily chart, we can see how vastly overbought we are here. We're outside the Bollinger Band, so a couple of days of meandering around these levels before the break up towards 230 would not surprise. We will absolutely not cover our shorts if we come back down towards these levels and fill slightly. Only a break below 187 is going to be significant as far as we are concerned, and that is that 117.16 level in the 5-year note that we've been talking about so much. So we will stay short while we are above this level and looking to add to our positions for a final move around the 230 level, which is somewhere around the 115 level in the 5-year note. If we look at the 30-year note, on the other hand, we can see that the price action last week was minimal, which basically means that the curve is flattening in an upward direction. 30 years are doing very little, while 2s, 5s and 10s are going up in yield. That is a bullish situation for the dollar. We have this long-term objective around 341 in yield in the 30-year note. We think we see it at some stage over the next few weeks into the first quarter of 2017, and that to us will probably coincide with the 5-year note being around the 235 level, and that's when we can actually say thank you very much. We think that the US has probably gone up as much as it is going to get up, and it's time to switch positions from being long upward direction in yields to probably long-term consolidation to down, and that is going to have quite a bit of impact on euro dollar and gold and even equities. In European interest rates, we have a completely unsustainable position. The Bund is right on top of the weekly trend line around 30 basis points, and it just cannot go higher as the ECB continues buying bonds, continues creating a shortage of collateral, and therefore the 2-year note keeps on making new highs. This situation in the Bund is absolutely unsustainable. We think it either in the next few weeks comes back down towards zero and then goes again, or it just goes. In either case, we think that buying long-term puts on any dip in the market when they sell volatility is the thing to do. We cannot see this situation lasting for much more than another month or so. Buying 6 to 9 month volatility, looking for breaks towards 1%, we think is the way to go. The interest rate differentials between the US and the EU are now as large as they've ever been, within 20-30 basis points, which is nothing. Therefore, at some stage, that relationship will break and it will be extremely beneficial for Euro USD. But at the moment, we think that if anything gets worse, with the bond yield getting pushed down towards 20, 15, even 10, we wouldn't be surprised to see it test this level around 07. But our long-term aim is certainly to see 1% again, before the first quarter of 2017 is out. Just to show you a comparison between 2-year notes in Germany and 10-year notes, this is the 2-year, the Schatz, which has been making new highs all the time as collateral is being sought by banks. And you can see the last time we were here, which was the top of this bar, the Bund was trading above 169, or certainly above 168, and now it's trading 162. That is a big interest rate differential, almost 40 basis points. So you can see how much the yield curve in in Europe is being held down by the buying in the 2-year note, which is making the 10-year note impossible to short, really, with any confidence, because you could have breaks upwards at any stage as people get squeezed out of their positions. Completely unsustainable position. Everybody knows that both contracts should be going down hard, but they're not, because the technical position in the market created by the ECB is such that it's almost silly at the moment to have outright positions in either. Working with long-term options is a much more preferable situation. Well, the interest rate differentials are weighing on Euro USD, which is taking up the slack. This is a daily chart. You can see that we have now broken below the all-time low of 104.62, and we are now probably going to cascade lower down towards 102 on the dailies. If we open a chart of the weeklies, we have this supporting trend line, which seems to be working very well, which now comes in somewhere around below 102. If we change it round to the monthlies, it is even more interesting. And we can see that the last time that we had an interest rate differential as large as we do now, the Euro USD was trading in this range, which is just below or around 90 to the dollar. Therefore, anybody who tells you that the market cannot go down 10% is actually not telling you the truth, because when interest rate differentials were last here, this is where we were. So we could, in the next few weeks, have a complete cascade, hopefully holding this trend line and probably going down certainly to below parity in the next few months. The first level that we'll be looking for is the high here, which we think is going to be a good place to cover some shorts, which is going to be around 102.06. That certainly would be the objective very, very shortly, or even a spike down to this level, which is going to be just below parity. So below 102 and parity is the level to take back shorts, looking for a bounce back up towards probably this trend line around 108 and then possibly back down. But that is the very long-term picture. 102 to just below parity is the level to take back the shorts. A lot of technicians will tell you that gold actually leads all those other asset classes, being a smaller contract and people having to do things earlier and faster. Well, if that is the case, we certainly see very little showing of a long-term bottom or a tradable bottom having been created. This level is around the 125, 130 is extremely important. We managed to close above it. After that, the only other really important levels come around 1073 and then the previous bottoms around the 1040, 1050 area. We certainly think that this bottom here, coinciding with this top there, which is around the 1050 area, 1040 area, is going to be extremely important. We see absolutely no reason until Euro USD, i.e. the dollar, gives us some indication that it's running out of steam, and we don't think it is, because we think having closed below the previous low and having objectives which are still 2, 3, 4% away, very short-term objectives, we don't see that gold is actually making a tradable bottom yet. It might have $20, $30 squeezes, but we just see no reason at all to step right in front of it and load up with gold. That is the way we see things at the moment. We hope it doesn't change in the immediate future. We see that certainly the market is getting very oversold on a weekly basis. If we change that to a daily basis, it would be even more obvious. We have had a very, very powerful move since Trump got elected, since election night, and now it would not surprise to see an area of consolidation here before the next move down towards 1050. If we look at the fundamental valuations of the equities now, we can see that we are still above the 17 times Blue Angel in the S&Ps. We see very little upside currently for the S&Ps from any sector. Consumer discretionary might have some, but very little. Consumer staples are, until we start getting bullish of bonds, we can't really see them screaming higher. Do they have some potential? Yes, but not so much as to take the index higher another couple of percentage points. Energy is still a complete mess, although it's rapidly getting better. The financials are right on top of their Blue Angel, and we think that they will consolidate here for quite some time. And when we say quite some time, we're probably talking quarters as opposed to weeks or months. The healthcare index is the one that is in an accumulate area. Although it is high risk, it is also high reward. So probably one of the sectors that defensively should outperform any other. The industrials are completely unable to go much higher. They are right on top of their Blue Angel. We think the industrials from now on, it's sell any rip. Looking for it to stay at best around this 18 times area. Information technology is the only sector that we feel has some room to go higher, and that is why we prefer NQ to ES. We are not saying it will go higher, we're just saying that fundamentally and technically it is the only one which is supported underneath and has some room to stay higher and remain higher, while all the others seem to be so close or above their blue angels that it's almost impossible to see them sustaining any rally. Materials, likewise, we just don't see them being able to break much higher than they are. And therefore, and telecommunications, yes, we like telecommunications. We think they trade 15 times earnings, and therefore they probably have another 5-7% in them. Utilities with bonds, very little upside. So fundamentally, we have a picture that it is almost identical to last week, but confirming last week. FV, the 5-year note, has broken the crucial level. Long-term objective is 230. Sell any rally up to 117.10 with a tight stop above 117.16 on a close above there. The bonds, as we said, you have to buy volatility. Every time the contract trades upwards 50 to 100 points, you have to nibble at some very long-term puts. We think that that will be very profitable at some stage in the first quarter of next year. The ES is our preferred contract for shorts, as it has no sustainable upside that we can see. NQ is preferred for aggressive longs, as it is the only one with sustainable potential because of XLK. The Russell 2000 is still on deep dips, the one we would buy and lock away, as it were. While European equities, we still prefer longs there over the US. And the US dollar, we have to stay longer volatility. We certainly think it trades that 100, i.e. parity to 102 area, where we can cover, and after that we could have a rally back up to 106, 108, and then probably back down. Current position is completely unsustainable. You cannot have a contract making new lows and then just sitting there. We have never seen that happen, and we're quite convinced it won't happen again this time. Why do we say ES is unsustainable? Well, we saw fundamentally why, and we can see technically why. We have a situation whereby it is still outside the Bollinger Bands. These are the weekly ones. We have made a bit of a doji on the I'm not convinced of it in the slightest. It probably at some stage trades down to this weekly MA and tags it. That's around the 2230 area, but we certainly wouldn't be looking for too much downside, much more downside than to 2230 over the course of the next couple of weeks into year end. As we all know, there's going to be very little trading, and the contract is more likely to squeeze than not. But we certainly don't think that anything above 2260 is sustainable for until year end, and probably for quite a little bit longer than that. The DAX is the one that has achieved all our targets, and we managed to get rid of the position on Friday. 11,430, 11,366. It has very nicely tagged the objectives, and now we have a situation whereby these weekly Bollinger Bands, the market has to trade back within them, so we would not be surprised by a move back down towards certainly this area, around the 11,100, 11,200 before the next move up. The DAX to us has achieved its objective. Thank you very much. Goodbye. The one that has not reached it is the stocks, which probably indicates the weakness of the periphery. The target to us is still 32.86, 87. We would like to see that tagged, and then we will be quite confident that even that all European markets are in for a period of consolidation, and retracement. Certainly this area, you can see how hard it has been for the contract to break it for many years going back. It is a it's tried it once, twice, three times, here four times, here five times, finally broken through, and has spent the best part of a year building up enough energy to retest it again. It might take several quarters here for it, or several months for it to have enough energy to move back up towards the 3,600 or 3,800 level, which we do see happening sometime next year. We think this kind of gap up here in around the 4,000 area will trade next year, and that is, well, that's a 20% move from these levels, but we certainly need to see a lot more consolidation here before it builds up a head of steam to break higher. And that is why we still say that the European equities are a much better long-term long than the American equities, but we shall see if we are right. For the time being, certainly the DAX has achieved its objective, and the stocks probably will fail to achieve its 30 to 86 objective. We hope it does, and then retraces back up to at least this trend line, which would be around the 3,150 area before it can build up a head of steam to go much higher. That is all we have for you this week. Important to leave this up for you again so you can see what our biases are. We are actually working all the way up to Christmas, and then for 1 or 2 days during the before the new year. So almost no breaks for us. Hope you have a lovely Christmas. This will be the last video we do for this year, but we are ready to do some more next year, and we wish you a very happy Christmas to you and your families, and a very happy new year. Thank you very much for following us this year, and we hope you enjoyed it.